Hi, everybody. I'm Jeff Hechtman. I'm with HMB Legal Counsel, or Horwood, Marcus & Burke, as some people may know it. I'm both the managing partner and one of the senior partners in the business and finance group. And my practice focuses in large measure on M&A and private equity and transactional work. The past year and a half has been unique in my 30 plus years of practicing law. We've gone from the world shutting down to the most robust deal market that has ever existed, to labor markets where you couldn't hire enough people, to inflation, a downturn, and the largest law firms in the deal market starting to let transactional lawyers go en masse. So a really, up and down roller coaster ride. And so it'll be very interesting to see what different people who come at it from different perspectives have to say. I'll tell you about our practice is middle market practice, which means most of our deals are for nice sized privately held companies, not in the public space. What we're seeing in the marketplace is still lots and lots of activity. People talking about what's going to happen, people concerned about it, but the deal market not collapsing.
Each person,
so
we'll come back and
why don't I start? Tom, do you want to start with your firm?
Is this working? Okay. Ravinia Capital, we are a boutique middle market investment bank. We focus on selling companies, and we focus on, and mostly it's been healthy stuff lately. And then we also are experts at the special situations, and in those cases, we help companies, figure out what they need, and then help them get to that solution, whether it's raising debt, equity, bringing in other professionals, or a sale, whether in or out of a bankruptcy.
John Bintz, I'm a partner at Valuation Research Corporation, VRC. We're a full-service valuation firm. Our firm has 10 offices in the United States, 250 professionals. We do about 3,500 valuation assignments annually. Our markets are private equity, credit funds, BDCs, publicly traded BDCs, and corporate clients, large and small, public and private. We have 15-member international affiliate group, so we can do international assignments as well.
Hi, I'm Travis Haynes. I'm a partner at Balmoral Funds. We're a middle market private equity firm. We focus on investing into mostly complex situations. We've invested a lot around foreclosures and bankruptcies. We've bought divisions out of larger companies. We've also purchased well-run and healthy businesses, private companies with really good operators. The theme for us, I guess to shorten it, we're old-fashioned value investors. The main thing for us are the people we partner with and the management teams that invest alongside us. And all of our deals are friendly, so we're not antagonists or activists coming into these investments. At the time of the investment, it's a very harmonious marriage being made, essentially, of capital and management.
So let's start with a question. I'm going to start with Tom. Tom, you're at the beginning of the funnel where you see deals before they happen. Mm-hmm. Are you seeing a change in your mix, a change in your volume? What are you seeing?
Yes, very much so. The market is really, and you were hinting at this, Jeff, but like right now, the last 4 months or so, I think we're at a real pivot point for both healthy deals and distressed deals. Really, the market is trying to figure out which way it's going to go. And right now, it's really almost on hold. The healthy private equity companies right now are talking about something, but they don't want to go to market right now if they don't have to, because the valuations in the public markets, we see the stock market, it's easy, it's gone down like 30%. Private equity, and then it's private, they can go mark to market, but you really don't know. And so right now, unless they have to, they'd rather hold on and see, because there's this contest going on, let's say, between all the capital that's been raised by private equity and it's on balance sheets, and we all know about that. And then there's the the potential that we have now, higher interest rates, and if they stay at that amount, that takes the money out of risky investments, as we've seen like Bitcoin go down and all that, and they shift over to bonds, and that could be, if that happens, private equity, if they went out, would be selling at a lower price. So they'd rather wait and see where it goes. So it really, right now, I see the public offering for debt is almost frozen. So like when we're doing a refinance for a commercial bank now, it's sure to be a privately held lender. And even they're like discriminating more because they're worried about the recession coming, inventory and stuff. But interestingly enough, I am getting more calls from some privately held business owners that have gotten through the COVID and they're ready to sell now. So we'll see if those go to fruition.
Gotcha. And so the next step on that, John, are you seeing pressure and valuation? Who are you seeing concerned about valuation? What trends are you seeing with respect to valuations?
Yeah, to add on to Tom's comments, I would agree wholeheartedly with what Tom had said. So the publicly traded markets went from a 23 PE down to a 17, and I think the private markets and the middle market probably 1.5 to 2 turns down lower. So what's good for the private equity is they can buy, so their cost basis is a little lower, but they may want to hold off a little bit on the sell side. Obviously, things are slowing down. We had COVID, we had fiscal stimulus, and now the Fed is tightening 300 basis points in the last year. So there's this tug of war between selling, buying. What am I going to do? There could be a little pause, but we're still pretty active. The M&A market is still pretty active for us in the valuations that we do. The private equity dry powder is still about $1.5 trillion, which is still a lot. Private equity are magnificent owners of companies. That's what they do. They're sophisticated. They're financial engineers. They're corporate governance. They have very focused and specialized industry focus of what they're buying and what they're selling. So that market, they have institutionalized and professionalized the buying and selling of companies. That will continue. I do not see that changing. So that will keep the M&A markets on a relative basis fairly active, in my opinion.
So Travis, you have the unique position of being a buyer, a seller, and an operator. What's happening in each of those different capacities?
Okay, so we don't view ourselves as operators. We partner with wonderful management teams that have the task of operating the investments, and we're just lucky enough to partner with them. So we are very involved and deeply knowledgeable of every investment we have. There's nothing lost in our portfolio, but we partner with those teams that do that. We're still seeing a lot of deal flow. It's out there. As we are slipping into the world of the unknown right now. It's starting to really appear when it comes down to price after due diligence. The bid-ask spread between a buyer and a seller is quite wide right now. Sellers are still thinking of the past and valuations they heard about or valuations their friend achieved a year ago. A year ago is not very long ago, but the availability of debt, investors are all cautious about what's around the corner. I mean, if we advocate for and make an investment and we stumble into an issue with the economy, and 6 months from now we're going to have to talk about that with our LPs, and it's going to be embarrassing. So we have to be extra cautious about the supply chain issues, the impact of higher interest rates. I mean, so it makes us more cautious. And that bid-ask spread, to put it into more context, we had tons of deals in Q3 and Q4 last year. In December, when we were kind of getting to the 5-yard line and valuation was kind of readdressed or reconfirmed, we were lower and the deals died. Maybe they come back, we'll see, but that just made it very noticeable for me.
And from the kind of mechanical side of doing deals, we're seeing a couple of different things. If deals are not going to go forward, it's typically before they get too deep into the documentation. It has to do with quality of earnings and numbers. Once they get past that phase and the deal's going forward, I'll break into 2 different categories. On the one hand, there's a group of deals. It's never been easier to complete a deal. Typically, those above $25 million, with the increasing availability and popularity of RWI insurance for good deals, it has never been easier from a lawyer's perspective to complete the deal because of the fundamental de-risking.
RWI, reps and warranty.
Reps and warranty insurance. It's a fundamental de-risking of a deal from a seller's perspective while still providing a lot of protection for a buyer. On the other hand, for those who try and do deals the old-fashioned way, it's harder and harder to get a deal done because you're haggling over every inch of the field. And so it's a very interesting dichotomy. And typically where you find it is RWI becomes very prevalent in deals 20 million, 25 million and above, and pretty much non-existent below that. So a very interesting dichotomy. And as you can see, you're getting both from all four of us significant ups and downs in activity. And so now I'm going to ask each of you guys to pull out your crystal ball. And I'm going to say, Tom, in the next 6 to 12 months, what do you see happening? Do you see the mix of deals changing? What do you see?
Okay, good question. And I think, I think it's a dice roll, and it's going to depend on if the risk on markets and the lenders feel comfortable again, then it could be very little distress type of transactions happen, and we're kind of back to the environment we had. My own personal feeling is that that the Federal Reserve is going to stay higher longer than most people anticipate, because I think they're worried about making another mistake and being called out on it. And they're also students of the Paul Volcker history in the 80s, where they kind of eased a little and then they had to go much higher. So I think what that means is that the valuations probably will be lower, and we're going to be switching to an environment where cash is more important. And perhaps for the first time in 13, we're going to have a distress market again. A lot of people have been speaking here about that. And so I personally think whatever happens, we're going to see more of that, because a lot of people, they got bailed out during the last couple of years with all the government finance, and it's just not going to happen again. So people in certain industries are going to get to the end of their liquidity, and there are going to be distressed transactions, distressed lending. We're already seeing quite a pickup in getting called in for people wanting kind of bridge loans, or and now we're starting to see a little bit of potential, what I'm hoping, instead of liquidate 363 sales, where we can keep them going as a going concern. So I think that's going to be it, but I'll say I was wrong about everything going into COVID. So take that for what it's worth.
So my view, crystal ball, and I'm not sure exactly what's going to happen, but here's the things that you should be looking at: interest rates, inflation, and disinflation. So we have an inverted yield curve. That makes the case for a recession. How deep? How long? We stimulated the economy for, give and take, 10 trillion, but we've also just taken out 10 trillion in the equities markets, with those going down 25 to 30%. So we've had 40 years of disinflation. When interest rates and inflation peaked in early 1981, we've had 40 years of disinflation and lowering interest rates. So on the disinflationary side, when you're looking at things to try to figure things out, technology is disinflationary. Demographics, and aging population in developed countries. Global workforce lowers labor costs. Central banks tightening, that's disinflationary. Raising interest rates, they raised in 300 basis points. Stock values decreased by 25 to 30%. On the inflationary side, tight labor market, demand for labor. That's inflationary. Government fiscal stimulus, inflationary. And supply chain issues, inflationary. Hopefully, China starts getting back to work, and the supply chain issues are less and less. But there could be offshoring, where people are leaving China and they're going to look at other supply chains in other places to manufacture. Inflation peaked in June at 9.1%. It'll be tough to get the 2% that the Fed wants as far as inflation goes, but they might settle it between 3 and 4%, which is still significantly lower than it is today. So in summary, we have an inverted yield curve. Typically, that means you're going to get a recession. How deep, how long? It depends. That's my views.
Travis, are your management teams that you partner with, are they running the companies differently? Are they conserving cash? How are those teams interacting with you on strategy?
So, yes, they are. Being very careful on inventory, I think, is number one. A lot in there. Downstream from them, there's a lot of destocking in different categories. Building and construction, for example. So that has a ripple effect. Our demand goes down significantly at first because of destocking, and then now we're kind of holding our breath to say what will the new normal level of demand be. But inventory, I think, has been an area of big focus for us. We did just sell a consumer products company. We sold it on 12/31, so this might be good insight for everybody. A gift company called Enesco, actually based in Chicago, where I know a lot of people are from. It's in Itasca. We owned Enesco for 7 years. It was great investment for us, great story. We made a lot of money on it early on. We sold a teddy bear business to Spin Master. That was a piece of that business that didn't fit well, and management made a lot of money. We continued to own the company. Just before COVID, we purchased Things Remembered, the mall-based retailer of personalized gifts, out of a bankruptcy. Enesco was the stalking horse bidder in the bankruptcy, and we had a plan for it. The integration of the two, cross-selling. I mean, there was a real thesis there. We left behind bad locations, took the best locations, took an online business, and it was overall $250 million of sales. So going into COVID, Things Remembered, stores shut down. Obviously, it was a big drag on earnings of the combined company. The online business did well and grew. The Enesco business that sells designs and sells products wholesale, coffee mugs and things with slogans on them, Christmas Village pieces. They own Department 56, which is a brand of Christmas villages. I don't know if you collect Christmas villages, but those sales went up, and Enesco's earnings went up through the pandemic because everyone was not traveling and buying product. But we had to suffer through the Things Remembered portion of the business. But we embarked on a sale process earlier this year. The market began to slip. We decided, well, the train's already left the station. Let's stick with it. And we sold the business in two pieces. Enesco sold to a company called NECA, which is a strategic gift company in the wholesale side of the business. And Things Remembered kind of got parceled. The portion of the business, the brand, and some of the inventory went to 1-800-Flowers, and the rest is just kind of being essentially liquidated away. But we were able to get that deal done. It was a good outcome. I mean, they paid a decent price. Might we have got a little bit more a year ago? Maybe, but the outcome was good, and we were really scared. Thankfully, we had strategic buyers that had a lot of reasons to buy the company, and they felt they were getting a decent deal, and we felt we were getting a decent deal too. So if I'm going to make any predictions, which I think it changes for me on a daily basis depending on how I wake up. So waking up in Miami, it's a beautiful day. I'm a little more optimistic. I was out with Matt Boardman last night, had a few too many drinks, so I'm a little fuzzy. But I also read that the Swiss National Bank had posted a $150 million loss, or $150 billion loss, which is more in over 100 years. So that's new news to me. I have no idea. I'm not smart enough to figure out what that means. I don't think it's going to be good. But if I'm to make a prediction around M&A, I think the first half will be slow. I think the market will be maybe a little more accommodative in the last half of the year. Strategic buying will still happen. I think public companies are going to think they can maybe have a better chance of beating out private equity in a market like this. A lot of structuring will take place. I think a lot of the SPACs are going to go belly up, and there will be a lot of work for a lot of you to do around those failed SPACs. But I think some deals will start to get done more in the second half of the year. In the middle market, we're still seeing leverage available, and it's a little more expensive, a little bit harder to get, but it's still there.
So I'm going to focus predictions a little more on sectors.
We got 5 minutes.
Okay. One of the things that we're seeing, I would tell you, over the past 5 years, the preponderance of transactions that we saw are what I'll refer to as asset light. Your assets walk in and out the door every day, service businesses and the like. Over the last 6 months, we've seen a pretty noteworthy shift from asset light businesses to asset heavy businesses, manufacturers, distributors, people who have inventory on shelves and equipment. I'm curious, Tom, do you see any sectors that you think will A, be particularly successful, or B, be particularly troubled?
Well, I think as far as trouble, there's a lot of different sectors. I think healthcare is kind of a mess, so there's a lot that's going to go on. There's senior centers in particular. Technology companies, I think, because the venture market's drying up, I think are going to have to survive on their own. So I think there'll be a lot there. And I think commercial real estate, you mentioned, Matt, office buildings, I think is just a disaster waiting to happen. I think it was good that you sold, because the goods and gift companies, I think it's going to be hard for them, because I think people's consumption is going to, go more towards services. So I see all that stuff, but I think it's going to be also particularly, it's not going to be necessarily industries, but I think we're going to see some companies that have been able to kind of use like free capital almost, that are now going to have a reckoning.
John, do you see, I'm going to focus your question a little bit. Do you see valuations fluctuating differently in different sectors? So do you see service sector?
Yes, definitely. I think the information technology, healthcare, business services, those valuations have maintained their levels, and the other sectors have gone down a little bit. Maybe a turn and a half to 2 turns in the other sectors other than information technology and healthcare and business services. The commercial property for office space, we live in Chicago. I go into my office 4 times a week. Mondays and Fridays, 20% of the people pre-COVID are downtown in the Loop. And Tuesday, Wednesday, Thursday, it's about 40%. So the office, I know LaSalle Street, for those in Chicago, they want to repurpose LaSalle Street. It could be residential housing. That would be unheard of 10 years ago.
So Travis, as a buyer and seller of businesses, does this impact the firm's strategy as to either what you see going forward, selling, or what you're going to be in the market to buy?
Short answer.
Yes, selling, we will, if we sell anything, it will be a very select type focused process. But most likely, if we can hold, we'll just hold on to it. As far as strategy goes, no, keep it simple and do what we've been doing. It's been working. So.
Okay, well, thank you, everybody. I think we're getting a signal that our time is up.
Yep, we're going to move. Thank you,